All right, it is time to get started. Good morning, everybody, and welcome to Coffee with Mark and Marcus. Yes, I'm back, and I know that you got used to having coffee with Mark. I hope you still like me. I missed you tremendously. I've been traveling for the past few days, but it's good to be back here. But of course, also Mark is here as well. Good morning, Mark.
Hey, good morning, Marcus. Nice to have you back. Good morning, everyone.
Absolutely. And thanks for the very warm welcomes here. So let's see who here wants to make money with trading. Come on, type in a yes in the chat box. Oh, yeah, absolutely. And let's see who here wants to make enough money with trading so that you can quit your job. Anybody wants to do that? Type in a yes. Let's see. And who here wants to make so much money with trading that you can travel the world and live the lifestyle you always dreamed about? Absolutely. Yes. See, we want that for you because, see, for most of you here with us today, this is going to be a long term relationship between us. I promise you. Because once we show you how simple this is, once we show you an easy way to trade, once you realize that this actually works, and once you realize that you can do this too, you'll want to hang out with us for a lifetime. I promise you that. So this morning is an exciting morning. So Mark and I just briefly talked before coffee with Marcus on what we're going to talk about today. And today we want to talk about different order types. But before we do this, let's take a quick look at the markets here, Mark. So what's happening? We have the E-mini S&P in the upper left, the Nasdaq in the upper right, and oh boy, the markets are down this morning, huh?
Yeah, it looks like we had a sell-off in early morning trading. This was right around the European Open. To be honest, I didn't look to see what was going on, but a little sell-off there and a little bounce, and it looks like we found a little support going sideways into the open, but we're down about 0.4% in the E-mini S&P, down a little more than 0.5% in the Nasdaq, and also crude oil had a little slide as well, down about 1.5%, trading back below $52 a barrel, but at 51.50 right now. So
Yeah, and I mean,
we'll
it really it's starting to get ridiculous. I mean, we make new all-time highs every single day, but based on what? I mean, for me, this is just hot air what that we are seeing here. But the Dow now had what 51 record closes this year. I mean,
yeah.
at some point we got to see a retracement, and here's my what I suspect when we see a retracement, it will be ugly. I mean, this is where I believe that we could see a day where the Dow is dropping 500, 600 points because, wow, I don't think that this is sustainable anymore.
Sure, sure. Yeah, once the selling starts, it's going to pick up quick just because there hasn't been a whole lot of selling.
Yeah. And you see, did you talk about it on of the 30-year anniversary that we had on Monday?
I didn't actually.
Okay, yeah, I don't know if you guys knew, but on Monday was the 30-year anniversary of the Black Monday that we had in 1987. And on that Black Monday in 1987, the Dow in a single day dropped 23%. If you look at the Dow right now at 23,000, this would be dropping 5,200 points. 5,200 points in a single day. This is what happened 30
Yeah.
years ago this week. I mean, wow, that's pretty crazy, huh?
That really puts it in perspective. A 5,000 point drop today. And I know that Black Monday was the big deal, but the date was October 19th. So, as far as dates go, today's the 30th
Oh my
anniversary.
gosh.
We'll see. I don't think we're going to get a 5,000 point drop today, but still, starting lower is something we haven't really seen too often these days.
Yeah, and I mean, after making new record highs basically every single day of the week, it's probably today where we might see a retracement. Anyhow, so we'll keep watching the markets here and what's happening. And you see, that's the wonderful thing. As a trader, you're not concerned about because you trade what you see and not what you think. And as traders, it allows us to take advantage of the volatility in the market. So we don't care if the market is going up or down. And this is where I think this saying is pretty cool. Whether bull or bear, I don't care, right, Mark? Because
Yep,
we really
yep.
don't care. We just trade the market. Anyhow, so what we wanted to cover today is a question that we had around order types. See, when it comes to order types, we have these different orders. We have stop orders, we have limit orders, we have stop with limit orders, we have market orders, and you see, it can be confusing. And this is why we thought we spent here a few moments this morning to talk about the different order types, because it's really, really, really important that you know when to use which order. Because if you use the wrong order at the wrong time, you could be in a position that you don't want to be in. So for your veteran traders, I mean, this is probably already well known, but it never hurts to have a quick refresher here. And for those of you who are new, this will be an extremely important session. So, Mark, why don't you, since you have the notepad up, why don't you talk about these order types for a little bit?
Sure. So the three main order types are a stop order, a limit order, and a market order. And sometimes brokers might refer to these with a slightly different name. And so sometimes that creates a little confusion. And one of the questions that popped up recently was, should I use a stop order on quote or like, what's that? And that's the same as a stop order. A stop order on quote is actually just a more detailed explanation of what a stop order is, because a stop order, actually, you know what, let me do this. Let's reorder this, because we should start with a market order. It
We
doesn't
should.
make sense to talk about stops until we've talked about market orders. All right, so a market order is, if you submit a market order, you're saying, get me in the market, right? You're not worried about no specific price. You're just trying to get in. So if you put in a buy order, if you say, I want to buy 100 shares of Tesla at market, then you're telling your broker, get me into this trade, buy 100 shares. And you're not being specific about price. You're just being specific that you want to get in. So a market order is the easiest way to get into a trade. It's also the easiest way to get out of a trade, right? Because if you are in a trade and you are long, if you bought 100 shares of Tesla and you want to get out, you could just submit a sell market order for those 100 shares, and you're just going to get out. The price that you get out is not specified. You're not controlling that in any way. You're just getting out. So market orders are good if you want to get in or out of a trade quickly, but you're not worried about the price. And actually, with our PowerX analyzer, if there's ever a signal to close a trade, right? You know that with the 3 exits, you have a profit target, a stop loss, and a possible signal to close based on the indicators. For those of you who use PowerX, that signal to close a trade is meant to say, hey, get out at the next day's open. So that would be where, if you're just a swing trader and you don't have the opportunity to watch the markets during the day, where you would want to use a market order, because the goal is to just get out of that trade. You're not trying to manage it or lock in a specific price. The goal is just to be done with that trade and to move on. So market order is the easiest to execute, but there's really no specifics to it or requirements other than just execute. Now,
Right.
this is why I
Now
wanted to
let's
go
talk about
back.
market
Oh yeah,
orders for a second, because there's 2 more market orders that you might see on your broker platform. The first one is a so-called MOO, which is market on open. This means that your order is being held at the broker and is submitted at the open of the market. Now, usually, if you're trading stocks or options, and if you're putting in a market order during the overnight session, this will be automatically executed in the open as soon as the markets open. So again, if you put in an order anytime between 4 p.m. Eastern time and 9:30 Eastern time the next morning, then this order will be executed as soon as the markets open. Now, another order type that we have with market is MOC. It's market on close. This is an artificial order that your broker is actually handling for you. It means if you're placing a market on close order, your broker is holding this order until the last 3 minutes before the markets close. So at any time during these 3 minutes, the broker can then, at his discretion, fire this order. And it really depends a little bit on the broker. Some do it in the last minute, some do it in the last 3 minutes. So this is when then the broker releases the order, and so you're getting filled around the closing price. And again, it's not at the closing price, so it's very important that you know this. If you place an MOC, a market on close order, you're not getting filled at the closing price. You're getting filled somewhere around that price as the market's already getting ready to close. So I just wanted to mention these two orders because they're variations of market orders here that you might want to be aware of.
Sure. And one thing to point out too is if you cannot find, like if you want to place a market for the open and you can't find MOO with your broker, that's okay. Some brokers don't have MOO as an option, and that's because it's just going to be a market order at the open if it's placed overnight, right? Normally what happens is some brokers will allow you to place orders in the after hour session, and so the MOO would designate that as an order that's not meant to be placed anytime except when the market's open. So don't worry if you don't see MOO as an option, because it probably just means that your broker doesn't offer after hours trading unless you like authorize it.
All right, so
okay,
let's move on to the stop orders.
Yeah, so I had to backtrack a little because I listed stop order first. And the reason why I wanted to backtrack and cover market order is because a stop order is essentially a market order with a trigger price, right? So with a stop order, and this is why some brokers call it a stop order on quote, you're saying, get me into this trade if we trade at a particular price. So if you place a buy stop order, you're saying fill the order if we trade at this price or higher. So as an example, if we were trading a stock and we put in a buy stop order for $100 a share and the market opens up at 99, then that order isn't going to trigger. It's just sitting there. It's working in the market because we have a specific trigger price that we specified. That's what the stop order on quote refers to, because the broker is looking to see the quote that you've specified in order for that order to be submitted and triggered. If we have a buy stop order for $100 and then the market opens at 101, we've traded above that trigger price or that quote price that we specified, and then that order automatically turns into a market order. So with a stop order, you're not specifying the entry price that you want, but you are specifying the price that you want the market to trade at in order for your market order to be submitted. And with our strategies, this is a type of order that we use for Power X entries. This is also a type of order that we use for our simple strategy entries. Because what we're looking for with the Power X signal, we want to see that there's a continuation of that trend and that the market continues to move in the direction that we expected. If we have a buy signal and the market gaps lower and we don't see that continuation, we don't want to be in that trade. So the buy stop order is going to help us prevent a scenario where the market just gaps down and continues to slide rather than trading through the signal price that we specified. Same goes for simple strategy trades. With simple strategy trades, we expect that if we trade up to the entry point that we've specified, that the market's going to continue to move higher or lower depending on the type of signal.
All right. Before we move on, Mark, let's for these two types of orders, let's do a few examples here. Let's just bring up the order platform and show market order and stop order, and then we can move on to limit orders.
Sure. So here we have the Infinity AT trading ladder, and this is for crude oil. Not that it matters, because it'd be the same idea for any type of market. But this blue line is showing us the current price, and we see that because markets are open, that price is adjusting. Now, if I wanted to place a buy market order, you'll see that I'm in that trade, right? I didn't specify the entry price. I just said buy at market, get me into the trade. If
Okay,
I
how
want
do
to
you know that
close,
you're in the trade? Maybe we should say this.
so
We should talk
yeah,
about the plus one.
sure. So with this platform, you'll see that there's a yellow highlight on the actual ladder, and this is giving us our average fill. So if like we were trading 20 contracts, then it's going to be average. But here on the left-hand side, you'll see a +1. That's telling us that we are long one contract for this particular market. So if I was to click sell market, right, I'm already long. I have one contract. And if I wanted to close a trade, I could just click sell market. We see that that +1 disappears. It now turns to a 0. The yellow highlight is gone because there's no average fill price. Since we're out of the trade, there's no current open position here, and we're now out. Now, just as another example here, if I click sell market, now I'm in the trade. We see a red one showing that we're short one contract. The average fill is 51.59, and you see we're not specifying any entry price. If I click sell market again, now I'm short 2 contracts, and then the market order is the quickest and easiest way to get into a trade, but we're not specifying where we want to get in. So we're really at the mercy of the market at that point. Okay, let's talk about stop orders. I'll just get out of the trade here. So now we're flat. There's no working orders, no open position. And so with a stop order, remember the idea is that you are specifying a trigger price, a price that the market has to trade at for your order to be submitted. But once that trigger price is hit, then it becomes a market order. So if I am placing a buy stop order, I'm putting that order above the market, because if I have that order below the market, it's automatically going to trigger, or it's automatically going to fill, because with the trigger price, if we say, hey, we want to place a buy stop order at 51.46, but the market's already trading at 51.60, that order is automatically going to be triggered. So the market's at 51.59, and I could put a buy stop order here above the market. And now we see in the ladder that there is this red highlight and a 1, and that 1 is under the stop column. So it's just telling us that the number is blue, so we know it's a buy order, and it's in the stop column, so we see that this is a buy stop order. So how would this order be triggered? It's going to stay here, and nothing's going to happen if we do not trade at 51.70. So if the market moves up to 51.66, 67, 68, 69, but doesn't trade at 51.70, the order's just working and it's not going to be triggered. If the market trades up to 51.70 or higher, this automatically turns into a market order and we get into the trade. Now, in the infinity ladder, I could drag it and drop it down. So I'm going to put it a little closer to the market to see if we could get into the trade. Now we see that the order is at 51.56, and it looks like the market wants to drop a little bit. I'll drop it down to 51.54. Maybe we'll get that triggered. So we're not quite there. There we go. You see how the market moved up, and it hit that trigger price that we specified, 51.54. So it immediately turns into a market order, and we're in the trade. Make sense? Now let's go ahead and let's talk about the opposite scenario, right? Because we have a buy stop order that we place above the market, where the market has to trade at that price or higher to be triggered, and we could place a sell stop order below the market, which is the same type of order, but it's a sell order instead, right? Because with a sell stop order, I put a sell stop order at 51.44, and this is saying that if the market trades down to 51.44 or lower, then this order will be converted to a market order, and we're going to get into the trade. Now, in this ladder, just to make it easy, we now have a red number that's telling us that it's a sell order rather than a buy order. The buy order was blue, and we see that this order number is in the stop column, so we know that it's a sell stop order. So I could tighten it up a little bit. Let me put it at 51.49 here. And again, if we trade to 51.52, 51.50, if we're at 51.50, but we don't trade at 51.49, it won't be triggered. But as soon as we trade at 51.49, it gets converted to a market order. There we go. So now we're short one contract, and the stop order was triggered like we expected. So a lot of people at first get a little confused with the stop order because we talk about profit targets and stop losses and stop orders to protect a position as an exit order, but they can be used as entry orders, and they can be used effectively as an entry order, and that's what we like to do with PowerX and also the simple strategy if you're day trading. So it's a valid entry order. It's just many times people start using it as an exit order, so it's a little hard to understand that, hey, you could actually get into a trade with a stop order as well. Okay, so I'll just flatten that. And as a day trader, when you click flatten, it's just basically automatically submitting an offsetting order. So just for point of reference, if I was long one contract and I click flatten, this would apply to day trading, not swing trading, but if I click flatten, then it's sending a sell market order for me. So I don't have to decide like what to pick there. Okay, any other comments on stop orders, Markus?
No, let's move on to limit orders.
Okay, so with a limit order, you are specifying the price that you want to enter at. Or it's not necessarily the enter, it could be to close too. So you're specifying the price, but the price is going to be the price specified or better, right? So sometimes a limit order is just called a limit or better order, because when you say, I want to get in or out of a trade at this particular price, and you're using a limit order, you're guaranteeing that you will get filled at that price or better, but the fill is not guaranteed. So with a limit order could be used for an entry price, and it could be used as an exit. For an entry, we like to use limit orders like with our Seahawk strategy, because we want to specify a specific entry. We want to get in at a particular point or better. We don't want to use a market order. We don't want to use a stop order. We want to get in at a very specific price. But there's no guarantee that we will get in at that price, because if the market doesn't trade at that price or through that price, that order could just be sitting there waiting to be filled, and we're not getting into a trade. Now, with a limit order, it's also used for profit targets, because once you're in a trade, you can specify that profit target that you want, how much, where you want to take profit. And so limit orders are great for exits when you're using a profit target. Now let's go ahead and go back to the ladder here and use limit orders as an example so you could see how they work in the market. With the stop order, remember that here's the market, this blue highlighted number, this is the last price traded, and we placed our buy stop order above the market. Now, with a limit order, remember you're saying, I want to get into this trade at this price or better. I want to be filled at the price I specify or better. So if we try to put an order above the market at 51.64, it's already trading at 51.51. So a limit order, it's just automatically going to be filled, because if you're trying to put in a limit order, because you're saying that you want to get into a price and the market's already trading at a better price. So limit orders are placed below the market, and I could put in an order here at 51.47. So the market's trading at 51.50. So with a limit order, you're saying, I don't want to buy at 51.50. I don't want to buy at 51.49. Don't want to buy at 51.48. I want to buy at 51.47 or better. So most of the time with day trading, you're getting filled right at that price that you specify, but you won't get filled worse. And there is the potential that you might get filled at a better price, right? If for whatever reason there ends up being no volume there, and the next order was at 51.46, you could get in at a better price, but you can't get in at a worse price. And again, the trade-off here is now you're specifying where you want to get filled, which you can't do with a stop order. But the trade-off is that there's no guarantee that you will get filled. If we trade down at 51.47 and we just trade at this level for a brief period of time, there might not be enough sellers for us to actually get filled at this price. If we trade at 51.46, if we trade through that limit price, we're going to be guaranteed to get filled on that trade. So that's the trade-off when you're being a little more picky, and when you're using a limit order, you are guaranteeing that you're getting filled at the price that you want or better. But see, we just traded at 51.47. Now we traded through it, so the market traded at a lower price than what we specified, and now we're long at 51.47. Any comments there, Marcus?
No, I mean, that's perfect. That's perfect. So this
We
is
could give a
exactly how
short example real quick.
Now, you know what I would like to do here, rather, because we're running a little bit out of time, let's talk about a stop with limit, because there was a question about how does it work when there's a stop with limit order.
Sure. So a stop limit order or stop with limit. With a stop limit order, you have your trigger, price, and a limit price. So a stop limit is combining these two orders. And in my opinion, it sounds like a great idea, because you have the benefit of a stop order where you're specifying your trigger price. You're saying, hey, I don't want to get into a trade unless we trade at this price. So that's the advantage of a stop order. And then it's combining the benefit of a limit order where you're saying, I only want to get in at this price or better. So it sounds like it's the best of both worlds. But the issue, and I think it might be a little easier when you see prices. Let me bring up the ladder. So let's say that we want to get in, maybe with day trading, it's not as easy as an example, but like, so with stocks, if we were to place a buy stop limit order, because we want to get in if a stock trades at $100 or higher. If the market gaps up to 101, that stop limit order now becomes a limit order, because it's been triggered, but because you're saying I only want to get filled at $100 or better, the trigger has happened, but now instead of becoming a market order, it becomes a limit order. And so you have a working order there trying to get filled at that price that you've specified. Now the tricky thing here is the market can run away from you, right? Because if you wanted to get into a trade, if the stock traded at 100 or higher and it opens at 101, the stock could move up to 102, 103, 104, and you're left behind. Now, the trade-off is you could potentially get in at 100 if the market comes back, so you get in at a better price, but it has to not only trigger, it also has to trade at the price that you've specified. So you could be left in the dust. Now, for a stop loss, this is another issue, because if we're long and we place a stop loss, like, I mean, I could do this right now. If I'm long, if I buy at market, and then I place a sell stop order at 51.36. So let's just say, let's make it 10 ticks just to make it easy. So my stop loss is 10 ticks below my entry. And I'm long, if the market comes back 10 ticks here, this is a stop order. So if the market trades at 51.35, I'm getting out of the trade. Now, if we were using a stop limit order instead, we're saying if we hit this price, I want to be filled at 51.35 or better, no worse. Well, the problem is if we have a fast market and the market just tears through this order, it could be that the stop price is triggered, but because you're being picky with where you want to get out, the market continues to drop. And so instead of just getting out with a 10 tick, 11 tick loss, right, because a stop order converting to a market order, you don't have a pick of what your fill price is, but you're guaranteed to get out. If that doesn't happen and you're trying to be picky and you have a fast market, you could be down 20, 30, 40, 50 ticks just because you were trying to be picky with your exit. So stop limit orders sound ideal. They sound like they're the best of both worlds, but in my opinion, for at least the way that I use a stop order to enter and to exit, it's too selective. It's being too picky with an exit or an entry, and I would rather just be in or out of the trade depending on my goal with a stop order. Does that make
I
sense?
agree. Absolutely. Now, I know that
Hey,
we're going
Markus,
a little
one
bit
last.
longer this morning, and I hope that you're okay with this, but I want to cover one more thing, and this is the so-called bracket order or an OCO order, a one cancels other, because that's an order type that you might use as well. It's actually not an order type, it is a combination of orders. So let's talk about an OCO order really quick, and then I know, Mark, that we already went over here a little bit, so let's see if we can cover it in the next 2 or 3 minutes.
Yeah, so if you say that you're long and you've bought one contract, right? So with a bracket order, this is an exit order type, and basically there are two orders being submitted because it's OCO, one cancels the other. So if you have your profit target and you're using a limit order, and then you have your stop loss and you're using a stop order after your long one, right? Then the limit order is working as your profit target. The stop loss is working as your stop order, and if these are not attached to one another and your limit order gets filled, the stop order is still going to be working in the market. And you don't want that to happen. You could cancel it manually if you want to do that. But if your profit target has been filled, you probably don't want that stop order just sitting there, potentially waiting to be executed and filled, because you really intended for one or the other to be hit, not both. So with an OCO order, it's really a fictitious order type. It's created by your broker where they're holding the orders and they know that they're attached to one another. It's a way to submit an order where if one gets filled, the other is automatically canceled. And I think this is also easy to see with the ladder here, because I put in these orders manually. But if we were to use the auto bracket, see how it says send auto bracket? I sent this bracket order, which in the infinity ladder is automatically set up as an OCO. So I have my profit target here, I have my stop loss here, and the profit target, this is a limit order 51.51. The stop loss is at 51.34. Now you just saw we traded at that profit target, and instead of having to cancel that second order manually, it's done automatically because it was an OCO. So OCO orders are a special order type that are available with most stockbrokers these days. And with day trading, they're super important because it's much easier to have an OCO order working for your profit target and stop loss instead of worrying about canceling it manually.
Yeah. So let's bring it all together of how do we trade certain scenarios. As an example, if we want to enter according to the Power X strategy or according to the simple strategy, we are using a stop order to get in the market. Now, this is where we have either a buy stop order or a sell stop order. So we're using a stop order to enter the market. As soon as we are in the market, we are then using an OCO order where we use a limit order for our profit target, and then we use a stop order for our stop loss. So I want to just give you here a quick cheat sheet. So of course you can remember all this, what we said here, or we're doing this quick cheat sheet here where you say for Power X, you're buying on a stop or you're selling on the stop, and then you use a limit order for your profit target and a stop order for your stop loss. If you're trading the simple strategy, it's the same deal. So this is why Mark wrote there, PowerX example, or for the simple strategy. Now, when you are trading the boomerang strategy or the Seahawk strategy, for the boomerang strategy or the Seahawk strategy, for the entry, you're using a limit order. So this is where we are using either a buy limit or a sell limit order. Now, for the exit, still the same. Nothing changes there. We're using the OCO orders. We're using a limit order for the profit target and a stop order for the stop loss. All right, so this is your little cheat sheet that you have here at the bottom. And what we'll do is, as soon as we're done here, Mark, if you could send these notes to Alex, because then we'll post them on our website right underneath the Coffee with Markus so that you have this little cheat sheet if you want to. So, I mean, that's what we wanted to cover today. And I know that we went a little bit longer, but I think it is an important topic because we receive a lot of questions around this. And we just wanted to make sure that you are aware of the different order types and you know exactly when to place which order. All right. Did we forget anything? I think we covered it all, right?
You know, Markus, because I think we could refer people to this session when they have questions. And there's one other thing I'd like to cover real quick. If you're in a trade, so if you are long because you bought shares, to close that trade, you need to sell, right? And if you own shares, you sell to close. Sell to close. If you are short, which means that you've sold shares as an entry, right? Then you, let me do this right. So if you're long, so you bought shares to open. And if you're short, you sold shares to open, right? Because you're trying to profit from a declining market. You buy to close this trade. Now, some brokers are going to refer to this as buy to cover. Okay, so it's the same thing. A buy to cover is just a buy order, but some brokers are going to say, like, as an order option, they're going to have buy, they're going to have sell, they're going to have sell short, and they're going to have buy to cover. It's the same type of order. Like, the order doesn't change. It's just a more specific option, and what it's doing is it's basically referring to that short position that you have. So if you are short, then you'd use a buy to cover option when you're putting in an order. And if you want to put in the trade, sometimes this says, the broker will say sell short. Does that make sense? Because sometimes when we're talking about buy and sell orders, we're just using the basic term because that's what most brokers use. But every now and then a different terminology will throw someone off. Just know that if you are long, you sell to close. If you've sold short, then you're buying to close, and buy to cover, you're covering the short shares that you've sold. So I didn't want to confuse anybody on that, but I know that that's popped up before, like, what do I do? I'm short these shares. Do I buy or do I buy to cover? If your broker gives you the buy to cover option, use that, because that's basically what a buy order is going to do anyway.
All right,
perfect.
Fantastic. Yeah, I think this rounds it up perfectly. So hope that you enjoyed this session. It's very important that you know these different order types. So review it if you want to. We will post the recordings on our website as always. And tonight's Coffee with Mark, or tonight's newsletter, you'll get a link to this. All right, fantastic. Well, thanks for hanging out. Even though the session was a little bit longer, I think it was a very important session. So all the best in your trading, and have a great weekend, because as you know, Coffee with Markus and Markus here is Monday through Thursday. So tomorrow there will not be any coffee. Take the day off, have a nice long weekend, and we'll see you again on Monday.
Have a great weekend, everyone.